Stop what you are doing for a moment, because something just happened in the global economy that could completely reshape the direction of gold and silver prices. This is not a minor headline. This is not one of those routine economic updates that markets quickly forget. What happened today in the latest U.S. jobs report is the kind of event that forces investors, central banks, and traders to rethink everything they thought they knew about where the economy is heading. And the reaction from precious metals was immediate and dramatic. The February employment numbers just hit the market, and they did not simply fall short of expectations. They collapsed. The United States economy did not add jobs. Instead, it lost 92,000 jobs in a single month. Let that sink in for a moment. Instead of hiring, instead of expanding, the labor market actually shrank. 92,000 jobs disappeared. At the exact moment that news spread across trading desks around the world, gold surged by $49 almost instantly. Silver exploded higher as well, climbing nearly $2 within minutes. Those kinds of moves do not happen randomly. They happen when markets suddenly realize that something fundamental has shifted beneath the surface. But if you think the story ends with a disappointing jobs report, you are missing the much bigger picture that is unfolding right now. Because while investors were still trying to process what those employment numbers meant for the U.S. economy, another development on the opposite side of the planet was already putting enormous pressure on the global precious metals market. And that development involves one of the most critical shipping routes in the world, the Strait of Hormuz. Right now, that strategic choke point is effectively shut down. The consequences of that closure are already spreading through global supply chains. Dubai, which serves as one of the largest and most important gold trading hubs anywhere on Earth, is suddenly facing a situation that almost no investor expected. Gold there is trading at a discount of nearly $30 per ounce compared to the London benchmark price, not because demand has disappeared, not because the metal is suddenly less valuable, but because the physical gold simply cannot move. Flights that normally transport gold bullion are grounded. Shipping routes are disrupted. Insurance premiums on cargo have surged dramatically. Logistics companies are struggling to move precious metals through the region safely. And as a result, gold is sitting inside vaults in Dubai that traders cannot easily deliver to buyers in Asia and beyond. For most investors, this kind of stress in the physical market is something they have never witnessed before. If you currently own gold or silver, if you are thinking about buying precious metals, or if you are simply trying to understand why these markets sometimes move in ways that seem unpredictable, this moment deserves your full attention. Because today we are going to walk through exactly what this shocking jobs report means for interest rates, how war-driven supply disruptions are beginning to split the physical and paper gold markets apart, which technical levels traders are watching right now, and why something happening quietly in Europe could end up intensifying the entire situation. To understand the chain reaction unfolding in markets, we first need to examine the labor data that triggered everything. The U.S. economy lost 92,000 non-farm payroll jobs during February. That number alone would be alarming. But it becomes even more significant when you combine it with revisions to the previous month. January's job creation numbers were adjusted downward to only 126,000 new jobs. That means the momentum in the labor market is not just slowing, it is reversing direction. The unemployment rate also moved higher. Economists expected it to remain around 4.3%. Instead, it climbed to 4.4%. It may sound like a small change, but financial markets pay extremely close attention to these details because they often signal turning points in the broader economy. For months, analysts have described the labor market as strong and resilient. But this report suggests that the first cracks may now be appearing. So why does this matter so much for gold and silver prices? The answer comes down to one central factor that dominates financial markets: interest rates. The Federal Reserve has kept borrowing costs elevated because officials were determined to control inflation. They repeatedly stated that they needed to see clear signs of economic cooling before lowering rates. Well, the labor market losing 92,000 jobs certainly qualifies as cooling. Weak employment data strengthens the argument made by policymakers who believe rate cuts should begin sooner rather than later. When interest rates start falling, the opportunity cost of holding gold decreases. Gold does not generate interest or dividends, so when investors can earn 5% in government bonds, precious metals face competition. But when interest rates begin moving down, those competing returns shrink. Suddenly, gold becomes far more attractive as a store of value. Silver tends to follow a similar pattern. Lower rates often weaken the US dollar over time, and a weaker dollar makes commodities priced in dollars, including gold and silver, more appealing to international buyers. That is why the reaction in metals was so swift after the employment numbers were released. Markets instantly began adjusting expectations for future monetary policy. Yet even while investors were digesting that economic shock, a completely different force was building pressure on the precious metals market, and that force comes from geopolitical instability. The conflict in the Middle East has escalated dramatically. The Strait of Hormuz, one of the most strategically important waterways on the planet, has effectively been closed. This narrow passage handles a massive portion of the world's energy shipments. Any disruption there immediately affects global trade. Qatar has warned that it will halt crude oil production until the fighting subsides. Iran has launched attacks on naval operations near Bahrain. Israel continues conducting airstrikes. Meanwhile, emerging market currencies and stock markets are experiencing their worst week since the global pandemic. Energy prices have reacted accordingly. Brent crude oil has climbed above $86 per barrel. Gasoline prices across the United States have surged to levels not seen in 2.5 years. One of the world's largest shipping companies has suspended several container routes entirely because the risks have become too high. This is not just another geopolitical headline. This is the beginning of a supply chain disruption that affects multiple industries simultaneously, and the precious metals market is feeling those pressures in ways that are not immediately obvious. Dubai sits at the center of the global gold trade. Large volumes of gold pass through the city before being shipped to major buyers in India, China, and Southeast Asia. When transportation systems function normally, the flow of metal continues without interruption. But today, the situation is very different. Because of the regional conflict, flights carrying bullion are grounded. Cargo shipments face significant delays. Insurance costs for transporting valuable metals have skyrocketed. Traders now hold large inventories that they cannot easily move to buyers. To encourage transactions despite these obstacles, some dealers have started offering gold at discounts approaching $30 per ounce compared to the London price. At first glance, that might sound bearish for gold. Discounts typically suggest oversupply, but in this case, the reality is very different. The metal is available, the demand exists. What is broken down is the logistical network connecting them. The infrastructure that normally allows gold to move efficiently from seller to buyer has been disrupted by war. And when physical supply chains break down, the relationship between paper prices and real metal can begin to diverge. To understand why this situation matters so much, you need to understand the difference between the gold price you see on your screen and the physical gold that actually moves around the world. When most investors check the price of gold, they are looking at futures contracts or spot market prices. Those are financial instruments that represent gold. They are not always the metal itself. They are promises, agreements, contracts that can be settled later. In normal conditions, that system works smoothly. Traders buy and sell paper contracts while physical gold moves through vaults, refineries, and shipping routes to meet demand. But the system only works if physical delivery remains possible when someone asks for it. The moment the infrastructure connecting those markets breaks down, something unusual begins to happen. Paper prices continue to move based on trading activity, expectations, and speculation. Meanwhile, the physical market begins reacting to real-world constraints like transportation, security, and supply disruptions. And that is exactly the situation we are seeing right now. Gold sitting inside Dubai vaults cannot easily reach buyers in Asia. Shipping companies are reluctant to transport valuable cargo through unstable regions. Insurance costs have surged so high that some traders simply refuse to take the risk. As a result, gold is effectively trapped in certain locations, even though global demand remains strong. So while gold in London is trading near record highs, physical gold in Dubai is being offered at a discount just to move inventory. That gap between paper prices and physical prices is not normal. It signals stress in the system. And historically, when stress builds inside the precious metals market, it eventually resolves in a powerful way. Sometimes that resolution comes when logistics normalize and supply chains reopen. Other times it happens when the paper market suddenly has to adjust to the realities of the physical market. Either way, these divergences rarely last forever. Meanwhile, another important piece of the puzzle is developing quietly in Asia. India is one of the largest gold consumers on the planet. Huge quantities of gold normally pass through Dubai before reaching Indian buyers, but right now those buyers are stepping back temporarily. Some of that hesitation comes from the difficulty of transporting the metal. Some of it comes from the fact that India imported unusually large amounts of gold earlier in the year, leaving inventories relatively high for the moment, so short-term demand has slowed slightly. But that does not mean demand has disappeared. What happens when the conflict stabilizes and shipping routes reopen? What happens when Indian buyers return to the market while weeks of disrupted supply chains have created bottlenecks across the system? That is the type of moment when prices can move extremely quickly. Supply and demand do not always adjust smoothly. Sometimes they collide all at once after a period of delay. And when that happens, markets can experience sharp and unpredictable moves. This is why investors should be paying very close attention to the current environment rather than dismissing it as another temporary news cycle. Because multiple forces are building pressure simultaneously. Let me ask you something important to consider. When gold jumps $49 immediately after a weak jobs report, do you think that move represents the full reaction? Or could it be the beginning of a much larger repricing of expectations? And when silver climbs nearly $2 in a single session, do you think traders have already finished adjusting their positions? Or are they just starting to digest the implications of weakening employment, rising geopolitical tensions, and tightening physical supply chains? These are the kinds of questions investors should be asking themselves right now. Because while most headlines have focused on the jobs report and the Middle East conflict, another development has been unfolding across Europe that could significantly influence precious metals in the coming months. Just a short time ago, financial markets were convinced that the European Central Bank would soon begin lowering interest rates. Economic growth across the Eurozone appeared weak. Inflation was showing signs of cooling. Many analysts believed the ECB would follow the same path expected from the Federal Reserve. But that expectation has changed dramatically in a very short period of time. Today, markets are suddenly pricing in a full probability of an ECB interest rate increase later in the year. That kind of shift in expectations rarely happens so quickly. Yet it reflects a growing realization among investors that Europe may be facing a very uncomfortable economic scenario. Government bond markets are already reacting. German bond yields have experienced their worst week in several years. 2-year yields jumped roughly 30 basis points in an extremely short time. Those kinds of moves signal deep concern among investors about the inflation outlook. The reason for that concern comes back once again to energy. Europe depends heavily on energy imports. When geopolitical conflict disrupts shipping routes through the Middle East, the cost of oil and natural gas quickly rises. Higher energy prices flow directly into inflation because energy touches every part of the economy. Factories require electricity and fuel. Transportation networks require diesel. Agriculture depends on fertilizers and fuel costs. When energy becomes more expensive, the ripple effects spread through nearly every product consumers buy. That creates a difficult situation for central banks. If inflation rises again because of energy prices, policymakers cannot easily lower interest rates, even if economic growth is slowing. In fact, they may be forced to raise rates further despite a weakening economy. Economists have a name for this type of environment. It is called stagflation. Stagflation occurs when economic growth slows, while inflation continues rising. It represents one of the most difficult conditions for central banks to manage because the usual policy tools work against each other. Lower rates stimulate growth, but worsen inflation. Higher rates control inflation, but slow the economy further. In those types of environments, traditional financial assets often struggle. Stocks face pressure from weak economic activity. Bonds suffer when inflation remains elevated, and that is precisely the environment where gold historically performs well. Gold does not depend on corporate profits. It does not rely on interest payments. It does not carry counterparty risk the way many financial assets do. Gold simply exists as a store of value that cannot be printed or inflated away by monetary policy. This is why gold has served as money for thousands of years, not because of nostalgia or tradition, but because of basic economic logic. When currencies face pressure from inflation and policy uncertainty, investors naturally gravitate toward assets that cannot be created out of thin air. Silver shares many of those monetary characteristics, but it also benefits from another powerful factor: industrial demand. Silver plays a critical role in modern technology. It is used extensively in solar panels, electronics, batteries, and medical equipment. As the global economy continues transitioning toward renewable energy and advanced technologies, demand for silver continues growing. So while gold responds primarily to monetary conditions and financial uncertainty, silver receives additional support from industrial demand across multiple sectors. This combination often makes silver more volatile than gold. During periods of economic expansion, industrial demand can push silver prices higher very quickly. During economic slowdowns, that demand can soften temporarily. But over the long term, the structural need for silver in technology and energy infrastructure continues rising. That is why many investors view silver as both a monetary metal and an industrial commodity simultaneously. Now let us shift to the technical picture, because understanding the charts helps investors recognize where major battles between buyers and sellers are taking place. Gold futures are currently trading near $5,128. The most recent high reached approximately $5,434. That level represents a significant resistance point. If buyers manage to push prices above that level with strong momentum, it could signal the beginning of another upward leg in the market. On the downside, $5,000 remains the critical support level. Round numbers often carry psychological significance in financial markets, and traders tend to defend them aggressively. If gold remains above that level, the broader bullish structure remains intact. If prices fall below it, attention quickly shifts toward the next support area around $4,900. According to the Wyckoff technical rating system, gold currently holds a rating of 7 out of 10. That suggests a bullish environment overall, though not yet an extreme one. markets could still experience temporary pullbacks without damaging the larger upward trend. Silver presents an even more interesting situation because its volatility tends to be higher. May silver futures are currently trading around $84. The recent peak reached approximately $95.86. That level stands as the next major resistance point that buyers hope to challenge if upward momentum continues. On the downside, the February low of $71.82 remains the key support level that sellers would need to break in order to shift the overall trend downward. At the moment, silver is hovering very close to its 50-day exponential moving average and the psychologically important $80 level. That area has become a battleground between buyers and sellers. Traders are watching the $80 level in silver extremely closely because psychological price levels often become the dividing line between bullish momentum and bearish pressure. When a market approaches one of these levels, trading activity usually increases dramatically. Buyers step in to defend the price while short sellers attempt to push it lower. If silver breaks decisively below $80, many momentum traders will interpret that as a signal that weakness is spreading through the market. That could trigger additional selling pressure and potentially drive the price toward $70, which is the next major support zone on the chart. Moves like that can happen surprisingly quickly because once technical levels fail, automated trading systems and speculative traders often pile into the move at the same time. However, the opposite scenario is equally possible. If silver manages to hold above $80 and begins climbing again, traders will start targeting the next resistance levels one by one. The first target would be $85. After that, the focus shifts toward $87.50. Then comes the major psychological level of $90, followed by the previous high near 96. According to the Wyckoff rating system, silver currently holds a rating of roughly 5.5 out of 10. That rating places the metal in a neutral to slightly bearish short-term position. In simple terms, the market is undecided. Volatility is high, sentiment is mixed, and traders are waiting for the next strong catalyst before committing fully in either direction. This type of environment often creates fast and sometimes confusing price swings. Markets can move sharply upward one day and drop quickly the next. That kind of volatility tends to punish traders who take oversized positions or react emotionally to short-term fluctuations. So what does all of this mean for investors trying to navigate the current environment? First, it is important to understand that silver right now is sitting at a crossroads. From this point, the market could move strongly in either direction depending on how the next few weeks unfold. Short-term traders may see opportunities to capture smaller price movements, but they must manage risk carefully because volatility can erase profits very quickly. Long-term investors should view the situation differently. For someone holding silver based on the long-term supply and demand story, short-term price swings are simply part of the journey. The underlying fundamentals of industrial demand, renewable energy expansion, and monetary uncertainty have not disappeared. That brings us to another factor many investors overlook: the relationship between energy prices and precious metals. Today, gasoline prices across the United States climbed to around $3.32 per gallon. That is the highest level seen in roughly 2.5 years. Gasoline futures themselves have surged about 27% in a single week, representing the largest weekly increase since the energy market turmoil that followed the Russia-Ukraine conflict. Energy prices matter enormously because they feed directly into inflation. Every product that moves through the global economy depends on transportation. Trucks require diesel, ships require fuel, air cargo requires jet fuel. When energy prices rise sharply, the cost of moving goods rises as well. Those increased transportation costs eventually show up in the price of everyday items. Groceries become more expensive. Consumer goods become more expensive. Manufacturing costs increase. Over time, the entire economy begins feeling the pressure. For central banks, this creates a serious problem. Policymakers may hope inflation will cool, but rising energy costs place a floor underneath inflation that is difficult to remove. As long as energy remains expensive, inflation rarely disappears completely. There is also another development adding pressure to global energy markets. China has reportedly instructed some of its largest refiners to suspend exports of diesel and gasoline. At the same time, Asian refiners that normally receive crude oil shipments passing through the Strait of Hormuz are suddenly facing supply uncertainty. Some refiners are even considering reducing production runs because they cannot guarantee steady crude supplies. That situation reinforces the idea that this is not simply a price story. It is a physical supply disruption affecting one of the most important resources in the global economy. For precious metals investors, this reinforces the broader inflation narrative. If energy supply chains remain unstable, inflation pressures are unlikely to disappear quietly. And when inflation remains persistent, gold and silver often receive additional support. Now let us take a step back and think about the broader picture unfolding right now. Multiple forces are converging at the same time. The United States labor market just showed unexpected weakness, with 92,000 jobs lost. That strengthens the argument for future interest rate cuts. At the same time, geopolitical tensions in the Middle East are disrupting global shipping routes and pushing energy prices higher. Meanwhile, Europe faces the possibility of rising inflation even as economic growth slows. Each of these developments individually would influence markets, but when several of them happen simultaneously, the potential impact becomes much larger. However, it is also important to acknowledge the risks involved in this environment. One possible scenario is that geopolitical tensions suddenly ease. If the conflict stabilizes and the Strait of Hormuz reopens, shipping routes could normalize quickly. When that happens, the safe haven demand currently supporting gold could fade just as quickly. War-related premiums can disappear almost overnight if tensions ease. Another risk involves monetary policy. Even though the recent jobs report appears weak, the Federal Reserve has consistently emphasized its commitment to controlling inflation. If upcoming inflation data surprises to the upside, policymakers could remain cautious about lowering interest rates. If rate cut expectations begin fading, that could place temporary pressure on precious metals. The final risk is purely technical. As discussed earlier, silver is currently sitting near a key support level. If that level breaks decisively, momentum traders could accelerate selling and create a rapid drop toward $70. Even if the long-term outlook remains positive, short-term declines can still create significant volatility. Because of these possibilities, investors should focus on having a clear framework rather than reacting emotionally to every price movement. One useful approach is to monitor several key indicators. First, watch the $80 level in silver. As long as silver holds above that price, the short-term structure remains stable. A decisive break below it would signal increasing downside pressure. Second, watch the $5,000 level in gold. That round number represents a major psychological support area. If gold stays above it, the broader bullish narrative remains intact. A break below it could shift sentiment temporarily. Third, pay attention to crude oil prices. Oil trading above roughly $85 keeps inflation concerns alive. If oil suddenly drops significantly, some of the inflation premiums supporting metals may fade. Fourth, monitor the US dollar. Precious metals often move opposite the dollar over longer periods. A weakening dollar tends to support gold and silver, while a strengthening dollar can create short-term pressure. Finally, watch the physical market itself. Premiums, discounts, and leasing rates often reveal what is really happening beneath the surface. Paper markets can sometimes exaggerate short-term movements, but physical demand usually tells the more reliable story. At this point, it is also important to address a common mistake many investors make. That mistake is confusing short-term price fluctuations with changes in long-term value. When silver drops 5% in a single day, it does not mean the metal suddenly became 5% less valuable. It simply means that on that particular day, there were more sellers than buyers in the futures market. The factories that require silver for electronics still require it. Solar panels still require it. Industrial demand does not vanish overnight. The same principle applies when prices move upward quickly. When gold jumps $50 after a jobs report, it does not mean the metal instantly became $50 more valuable. It means traders adjusted their expectations about interest rates and economic conditions. Short-term price movements reflect positioning and sentiment. Long-term price movements reflect underlying fundamentals. Investors who confuse those two concepts often end up making costly mistakes. Many people buy precious metals because they believe in the long-term fundamentals. But when prices temporarily decline, they panic and sell. Then when the market eventually recovers, they find themselves on the sidelines. That is why it is important to decide which strategy you are following. Short-term trading requires strict risk management and quick decisions. Long-term investing requires patience and confidence in the underlying thesis. Right now, the broader fundamentals supporting precious metals remain largely intact. Weakening employment data increases the possibility of future rate cuts. Rising energy costs reinforce inflation concerns. Geopolitical instability continues supporting safe haven demand. Meanwhile, structural demand for silver and technology and renewable energy continues expanding. None of those forces have disappeared. What has changed is the level of uncertainty and volatility surrounding markets, and that is exactly why staying informed matters more than ever. The current environment is unusual. A major economy losing 92,000 jobs in a single report is unusual. A critical global shipping route being disrupted is unusual. Central banks facing inflation pressures while growth slows is unusual. When unusual conditions appear, markets often respond with large and sometimes unpredictable movements. The key for investors is not to panic, but to remain calm, informed, and focused on the bigger picture. Because in times like these, the decisions made with clear thinking often matter far more than the headlines dominating the news cycle.